To get his views on the European debt market. Jim McCaughan is CEO of Principal Global Investors. They have $227 billion in assets, and last June he told us the European debt crisis wasn't over. Since then, obviously, credit problems have spread to Ireland. Concerns now in Portugal and Spain. Jim, tell us, first off, your views on the auction here. I mean, when I woke up and read about the finish of the auction, it seemed optimistic. You know, the yields were better than the secondary market, better than the last auction. Demand was 3 times the last auction. International investment, although you don't really know what that means in Europe, was 80% of demand. What do you think?
Yeah, I think, Matt, it's a relative success relative to what some people feared. But, you know, the yield on the 10-year was still nearly 7%. Germany only pays 3%. That difference shows that investors are really quite concerned about the risk in Portuguese debt, and I think they're right to be concerned about that risk.
Jim, just before the break, you kind of said that the auction was a relative success. I want to bring back some more of our interview earlier with Bill Gross on what he had to say, because he's still pretty much a skeptic. Listen in, everybody.
They're not really auctions. They're bought by domestic banks within Euroland, and then they're rediscounted to the central bank, and so it's internal buying. You know, there are claims of Japan and China and so on, but they're really looking for the private institutions like PIMCO and other insurance companies to buy, and we just haven't done that yet.
All right, Jim, so Bill Gross isn't buying, at least not yet. Are you guys buying any of this?
Yeah, no, we're not. And, you know, I think the problem is that there is just too much debt in several of those countries. And in that category, I'd put Greece, Ireland, Portugal, and Spain. And all of those countries have so much debt that long-term they will not be able to service it, and ultimately will need a haircut, a rescheduling, which will lead to investor losses. Wait for that before buying.
When does it happen?
Well, it's an interesting question, Carol. The EU backstop that was put in place 9 months ago runs through to about April 2013. I think that the market will start getting very jittery about that potentially being withdrawn sometime late this year. So I think that the rescheduling, the haircut on the debt, is more likely to happen in 2012 than in 2011. But I think 2011 will see a high degree of volatility brought about by a number of concerns over the refinanceability of the debt.
Why, you know, Jim, a lot of people say this is ultimately going to end in a restructuring. Why don't they just do that? I mean, why don't you just bite the bullet and get it over with, or would it cause too many waves to the fragile economic recovery?
Yeah, I think it would cause a lot of waves. You know, one of the things we've been looking at actually is the question of contagion, because on a rescheduling you have to worry about, you know, what else does it affect? Who does it hurt? And, you know, one positive sign has been an unwinding of the CDS market. There is actually now very little net CDS exposure out there to the debt of the peripheral Eurozone countries. That reduces the risk of contagion, but does not eliminate it.
What do you think happens, by the way, in the eventual rescheduling, inevitable, a lot of people say, of European debt to the euro? I mean, does it hold together? We heard Angela Merkel recently say she would do whatever needed to save the euro, which is also fairly surprising coming from a German politician.
Yeah. Yes, it is, but I think that the euro will hold together. I think the 17 current members will stay in the euro in spite of the pressures to withdraw. It is technically very hard for any country to get out of the euro. There's no procedure laid down. How you deal with bank deposits and international contracts would be very difficult. So I expect to see rescheduling of debt, but I think these peripheral Eurozone countries will stay in the euro on a long-term basis.
Jim, what are the broad global macro impact, if you will, of these debt issues? Is it similar to what happened, the financial crisis here in the U.S. and that global fallout? Do we also see that with the European situation? Do we get significant global fallout in your view?
Yeah, I think probably not, although that's a dangerous thing to say. One of the reasons I say probably not is the degree of CDS unwinding that has happened in the last 12 to 18 months. Because if you recall, Carol, the thing that made the subprime crisis so painful was all the CDS exposure, which multiplied through the system the losses resulting from subprime. That should not happen with the Eurozone sovereign default. I do think, though, the thing to watch is the capital position of European banks and insurance companies. Most of this debt is sitting on their balance sheets. When it reschedules, that will be a hit to their capital. And it'll be very important that they either raise capital in advance of that, which they've been doing, or make sure otherwise that they have an adequate capital position.
What banks over in Europe in particular do you think that bear close watching?
Yeah, I think a lot of them do. I mean, the British banks have exposure to Ireland. The French and Italian banks clearly have exposures. Obviously, the Spanish banks. So I think you have to be looking pretty broadly at the exposure they have to the debt of the countries likely to reschedule. And, I think you're already seeing a number of these banks raising more capital, which I think will be necessary if they're going to continue lending and doing business through a period of rescheduling, because that's the way it would hurt the economy.
Bottom line, Jim, how key is it for us to watch the Portuguese and Italian auctions this week as regards to the U.S. equity market?
Yeah, for the U.S. equity market, I think this is one source of volatility. I remain quite optimistic, quite constructive for the U.S. equity market for 2011. I'd expect it to rise 10 to 20% over the year as a whole, but it'll continue to be a bumpy ride.
10 to 20%.
And a failed auction by any of these countries could lead to a fairly significant setback, 4 or 5%, a lot of volatility. But, that would be a buying opportunity because the U.S. economy is recovering and U.S. equities are a good place to be. So treat these setbacks as a buying opportunity.
All right. Hey, Jim, thanks so much. Always a pleasure to have some time with Jim McCaughan there from Principal Investors.